I come here today certainly after close to 50 years in this business, not as an expert because this thing is brand new. As Jonathan said, where all we've got really is the text of the legislative bill to work off of. Everything else is up in the air, but I hope today to be able to give you an idea of how the thing works and maybe the magnitude of the dollars involved. There's going to be a bunch of questions. Some I might just not know, some I might just speculate on, some I'm just, I might have an answer for. So we'll give it a shot. I thought I'd start with kind of a little fun slide here. I believe it's, oh boy, this is a quick mouse. If I can get, where did I go? He just here. This thing here is, I think I need to stand sideways to get it to work. So right here?
Right here, this one.
Right there. Okay, all right, well, that's, talk about cat. This is, I guess I'd have to say, not what we're talking about today. But it's probably what many of you would just soon be talking about, right? The second slide here, this, frankly, is a tearjerker. I put it in here because, we can wring our hands over this stuff. And by the way, it's not just you guys paying this cat tax, it's me too. We could wring our hands, we could get upset, we could do a lot of things. But somebody gave me this slide a number of years ago. Obviously, Dust Bowl days. I don't know if you can see it or not. The little boy in the picture, if you blow that picture up, look on his face, you can tell he's crying. I'll bet the dad is crying inside too. So things could be worse. Slide number 3, I think you've got, and in some ways, I almost think I think I'm going to divert from what I intended to do because you really can't read my outline from back there for the most part. So you've got this outline in front of you, and I'm going to go over things and then occasionally refer to this. Let me see. Hopefully I don't mess this totally up. I think there's a full screen mode. I don't know if that helps or not. It's less distracting maybe. So what is this animal? Well, to start out with, I would just say it's really a type of modified sales tax. Oregonians have refused to pass a sales tax. It does make me wonder a little if the time couldn't come, this might be considered unconstitutional, but I think there's been a lot of lawyers look at this for the legislature and they're at least given a shot at it. But we, the people, have not voted for a sales tax. That's kind of what it is, sales and use tax. We're seeing a lot of this in my CPA practice because so many businesses, including rather modest farms, in some cases are becoming multi-state operations. So state of Washington, state of California, we have to deal with the sales and use tax. And as we go through this, there's going to be aspects of that that we can see in this legislation. A little bit about terminology, not a big deal about it, but the state of Oregon is using a corporate activities tax as I think it's in the legislative title. So you hear about this corporate activities tax, but Then they go on and they describe it as a commercial activities tax. Don't be fooled by the word corporate. It applies, they go into the legislation and it applies to all persons. They use the terminology persons. So the fact that you may or may not be a corporation's got nothing to do with it. They're going to tax you on gross receipts. To go into the calculations, and if you're just following the narrative here on this handout you've got in front of you, I tried to briefly explain how that works. The tax is going to be $250 plus 0.57 of 1% of each taxpayer's taxable commercial activity that exceeds $750,000. Now, it started out with $1 million, but then I think it was the Technical Corrections Act that got passed sometime this summer, lowered it to $750,000. It's my understanding, and again, this isn't clear from the legislation, it's my understanding each one of you persons have got one of these, $750,000. If you control multiple entities, you only get to use it once. The regulations aren't out yet. I don't know how you allocate between it. I don't know how you're going to report it on a form, because none of that stuff's out yet. But keep in mind, you can't split your operation up into 10 pieces and get $750,000 exemption 10 times. What is very common, though, for estate planning purposes and for other reasons, is to have multiple entities involved in an operation. And that gets to the unitary concept, which I'm going to deal with a little further on. So just kind of file that away, the unitary business concept, because it sounds to me like there is a tax selection that a lot of you ought to make in regard to that. So again, this applies to most folks except government entities. They're not going to tax themselves. Tax exempt entities, these are the nonprofits for the most part. And for the most part, ag cooperatives are exempt. There's been confusion on that. I've had people say, well, I sell to a co-op, therefore I'm exempt, right? And no, the exemption is at the co-op level. It's to the extent they do business with their members, that revenue base they're exempt on. But the farmer that is selling to the co-op pays the tax. They tried to soften it a little by reducing the income tax brackets, but as I pointed out here in my notes, not by much. A little bit on the lower brackets, but if you're married filing joint and have over $250,000 income, they didn't change that 9.9% bracket. So again, I may be just repeating, but this is not in lieu of, this is an addition to your income tax. In addition to. And just looking at these samples here, these hypothetical calculations, I'll point out one thing here right now on this. If you look at the top section, the income tax column, you pay income tax on the $500,000, which is after all the deductions. The CAT tax starts with revenue, allows some of the COGS, which we'll get into that. Then they give you a general exemption, $750,000, and that number you're being taxed on here is not profits. If this farm, or whatever business you want to call it, if instead of $500,000 profit was a negative $500,000, so it's a lost year, this column on the right wouldn't change. So one of the downsides of this thing is that businesses, and it could be some kinds of types of farms, because you take a grass seed farm versus a blueberry farm, the numbers and metrics change. I would say just on those two, as a generality, the grass seed farm is going to have a lower percent bottom line in compared to revenue than the blueberry farm. But none of that matters, because this cat tax is based on gross receipts with a couple adjustments. And if there's a loss, you still pay the cat tax. It's not fair, and we could get into a crying session here, but that's the way they've written the thing. So the commercial activity gross receipts. Now on this sample I put revenue. Probably should have used a different word. It isn't revenue, it's gross receipts and a bucket full of other stuff. And I'll get to that in just a moment. But there's also the question of nexus. Now I don't know if we have a whole lot of issues with that here in this room. Nexus refers to whether or not you're subject to tax, and usually it's in a multi-state context. So if you have a part of your farming operation in Oregon, part of it's in Washington, whether or not you're subject to the Washington sales and use type taxes depends on whether you have nexus. And if you have land there and a business operation, I can assure you, you have nexus. The question has always been, if you're doing something there, but you don't have a physical presence, you're just selling it to the other state. Well, most of the time now, they're saying you don't have to have physical presence, just an economic presence. And if you have an economic presence, you have nexus. That's how the term nexus is used. And in this cat tax, the legislation is saying that you have substantial nexus if you own or use a part or all of its capital in the state. This probably has more to do with an outside operation, farming operation that would have an operation here in Oregon, would fall under this. You either have authorization issued by the Secretary of State, which would be like a license to do business of some kind, or have a physical presence, or they broaden this thing way out about as far as you can get by saying otherwise has nexus to the fullest extent permitted under the U.S. Constitution, whatever that means. I'm next going to get to an area that probably is the one of the bigger, there's a couple of large issues for agriculture. This is one of them. COGS, that stands for cost of goods sold. In commercial accounting and taxation for manufacturing, for most commercial business entities, cost of goods sold is a bucket of costs that apply to the manufacturing process or the construction process, to where those deductions are the major costs and inputs into creating the product that's being manufactured. It includes some overhead items, some it doesn't. Doesn't include any sales and marketing costs, doesn't include general overhead, and it's linked to a definition. The legislation uses this section 471 language. Well, that talks about inventory. Really, you're on commercial accounting, what goes into COGS follows the definition of inventory accounting. What has to go into creating a number for inventory? Well, why am I talking about inventory and all this? As farmers, you don't deal with this. And that's really, that coupled with the fact that as farmers, you generally don't use the concept of cost of goods sold or COGS. But the law is written saying this is the number you use. So what's that mean? Well, regulations are going to come out and hopefully they address this. It means you've got to come up with a COGS number of some kind. And what are you going to put in there? Well, I had one farmer tell me, all my expenses are COGS. Well, that's probably an overreach. I would say, simply put, your general costs of operation, professional fees, maybe office, some things like that is the general administrative type costs. Your sales and marketing, it depends on the kind of farm operation you are. Some don't have much of that. If you just take your product to some place that buys it and you have everything under 1 or 2 contracts or a handful of contracts, but that is also not COGS. Most of the rest is. I'm speculating now. I think you're operating your equipment, maintaining your buildings, all of this is part of the farming operation, I think is COGS. And 35% of that is deductible. So here, again, looking at this top section, you got the income tax column, and let's just say in this example, COGS is 1.5 million. According to the CAT, you get 35% of that offset against your gross receipts. And so with your accountants, and maybe some of your own ingenuity and this and that, you're going to have to work through something to kind of come up with a different classifications in your books to be able to capture that 35%, to get the 35% deduction. Yeah.
So if you're having livestock, would the cost of goods sold include the hay and forage? Yes.
I would think so.
Fair market value, or?
It's using your regular accounting methods. It wouldn't be fair market value. There is fair market value on a couple items that are going to be coming up here, but no, that would be cost based. There's an alternate calculation, total labor costs, which I think is defined without payroll taxes. If it's a greater number, and I've been scratching my head trying to figure out how it would ever be a greater number, but I suppose, I don't think it's linked to COGS. So I suppose if you had a high-paid rancher and a high-paid sales crew, maybe that number could get bigger than COGS, but I find it kind of hard to get there.
As a blueberry grower, we can put out a lot of money for wages for picking blueberries. And I would assume in our end, that could be higher than COGS.
Which is a possibility, although that number would be in COGS. You're picking costs. And that's kind of why I'm saying that. It's already in COGS, so I think to get a bigger number, there would have to be other classification of COGS that are not, of costs that are not in COGS to be able to get that to be a bigger number. I think most people will probably use the COGS. To go on here, and I want to be sensitive to time here, and it's not my intent to turn you into some kind of cat tax accountants. There are some things that are exempt from it, and interestingly enough, capital gains, including sale of business assets, it'd be the gross revenue from that is not subject to this tax. So you sell land, you sell machinery, not subject to this tax. Hedging transactions are apparently not subject to it, but I have to say, I don't know what that means, because at the end of the day, with a hedge, you're getting revenue. It's just a type of sale transaction. So that, I have to say, exempt hedging, I'm just not sure what that means.
So does that mean if you make money, you don't write it off, but if you lose money on your hedge, you write it off?
Makes you wonder, doesn't it? If you borrow money, now there's, you know, and that gets into your deposits, that's not considered a receipt subject to this CAT tax. Then I'll kind of speed up here so we can get through this. Dividends, interest, insurance proceeds, distributions of pass-through entity, sales to wholesaler in Oregon. Well, certification time, I'm going to get back to that one. That maybe doesn't make sense right now. Sales of groceries. I think the Farm Bureau is trying to get food crops raised at the farm equivalent to groceries, but that's not in the bill yet. And transactions between members of a unitary group, I want to go over that here in a moment too, because I think there's some tax planning there. And then certain pass-through taxes on certain kinds of transactions are not subject to it, but it's written right in the statute. You can't pass the CAT tax on. Now, I know you probably don't believe that. I mean, the consumer ends up paying taxes, really. It's built into things. They don't want you sending an invoice with the CAT tax there that blatant. But if prices of things go up so people can survive, it becomes part of the cost of goods. And so it's going to happen indirectly, but I guess they don't want you to do it overtly. I mentioned the sales and use tax, and this one here is kind of a tough one. Probably everybody in this room has bought machinery and equipment from out of state. Most of the sales and use tax has to deal with that because they want you doing business in the state. They don't want you, Washington doesn't want its people coming to Oregon to buy cars and machines and things and take them back up to Washington to bypass their tax. Well, Oregon has done something similar with this. So if you go out of state and buy a used combine, bring it into Oregon, the fair market value of that might get added to that top line total revenue and subject to the CAT tax. Now, the legislation is very gray because it says unless you can prove you didn't intend to evade the CAT tax. And I'm here to tell you, I don't know what that means. So hopefully regulations are going to clear that up. I think what it means is if you couldn't find a machine in the state of Oregon that you wanted and had to go out of state and brought it back, you probably don't have to pay tax on it. But if there's a whole bunch of machines here available and you went out to get one out of state, try to avoid the tax, you're going to get nailed on it. I think that's what it means. The unitary groups. You go to this bottom section, I want to explain kind of how I think this works. The first column is the same as up above. But let's say in addition to the operating business, you have a leasing entity. It's my understanding, and I don't know how they're going to allocate the $750, but it's my understanding one operation that's under common control, you get taxed on all of that. So under this example, the tax is about $7,000 in the operating business, and the leasing entity, another $3,100. Now, the fact the leasing entity sells to the operating business and you got this back and forth initially is irrelevant unless you can qualify as a unitary group. And it's my understanding there is an election statement form that will be filed, and you'll have to register. And if that works, then the tax is not subject to transactions between the entities. So the 500,000 there, under the adjustment column, I pulled that out. But why did I add, or why did I pull 175 out of COGS? Well, it's because if you're part of a unitary group, you can't have these transactions not subject to tax claimed as a deduction in COGS. So the 175 is 35% of the 500, which I'm presuming was buried in COGS over here. That's a little bit into the weeds. But the point I'm making, and this is out of the weeds, I think, under this example, the 7,000 and the 3,000, a little over 10,000 tax, making this election, filing as a unitary group, it's 8,000. So there's a tax savings there. In terms of the unitary groups, it requires more than 50% common ownership, and it can either be a parent-subsidiary relationship or brother-sister. Parent-sub is when a business entity owns another entity. Brother-sister is where the same people own more than one enterprise. So one is owned by the business entity, the other just by the stockholders or the members. Either one works under these rules. There's some problems with the cap. I've mentioned one of them. Actually, I want to go back to something I said I would get to, and that is this exempt receipt here. Sales to a wholesaler in Oregon, where the seller receives certification at the time of sale, the buyer will resell the property outside of Oregon. There's a lot of egg products that get exported to another state or even outside the US of A. The question is, like with blueberries that are exported, I spoke just briefly to Carl Detweiler here about that. My guess, and again, speculation, and I don't know how many of you are familiar with the interest credit to domestic international sales corporations, IC discs. My suspicion is you're going to have similar rules. In that, as long as the product that is exported, where it stops off on the way there, as long as it is not modified or changed in any substantial way, with the IC discs, grass seed works well. I mean, you can clean it, or actually blueberries too. You can clean it. You can even rebox it to a certain extent, but as long as you don't really materially change it. An example of changing it would be if the blueberries were pureed and put in some other product before it got shipped out. That would be a major change in the composition of what it is versus just the raw farm product. So I think that if it goes out of state, an out-of-state buyer with a wholesaler, and they talk about an exemption certificate. Now, they also say you have to have that at the time of sale. You can't go back and get it later, I guess. But this is common in sales and use tax states, to where if you have an exempt transaction and you sell it to someone who has that resale certificate, then you're off the hook. And so I think they're following law that's found in the sales tax states with this. Now, to the extent your farm products are exported fairly directly without a lot of modification, would even include cattle. When it comes to cattle livestock, is it a material modification to slice and dice that carcass? Or do you have to ship them out live? These are all questions that I can't answer because there's no regulations. Now to problems with the CAT. One of the problems is we can't plan because we're not going to get regulations, as far as I know, until the end of this year. And it starts January 1, 2020. There are quarterly payments that will need to be made. And we don't even know how to calculate the thing yet. But we'll have to do something. My guess is when it comes to any penalties or anything like that, I think we're going to get big passes right at the beginning. It would be the fair thing to do, and usually that's what's done, as long as the error, so-called error, wasn't egregious, intentional, fraudulent, and so forth. If it's just because we don't understand the rules, my hope is that they'll give us passes. The other problem with the CAT is its pyramiding nature. If I have a client that pays me for professional services, and this goes into their overhead category up here, does not get as a deduction against the CAT calculation, I am paying the CAT tax on it, and so is my client. And you go through the manufacturing, the business process, you can just, no matter what it is, every level is getting recalculated, with the exception of maybe 35% of some of it, in some cases maybe is dropping out of the system. So it's kind of got this nasty pyramiding effect inside of our economy. I'm not an economist, but it's, I think it's pretty easy to figure out how, as a tax system, this pyramiding effect is going to line government's pockets more than what it appears just on the face of this. We already talked about the unitary group concept, that you can end up with tax being paid on transactions between groups unless you fall into where you can elect that unitary group taxation. We've already talked about the disproportionate impact on industries, even within the ag sector. Some farm commodities or more commodities aren't as valuable as others. And so when you compare revenue to profits, maybe one farm, one commodity would be generally 5%, another one might be 25% or 30%. None of that matters. Everybody gets hit the same, so it's disproportionate. And it's especially disproportionate against those with losses or slim margins. This has got like the auto dealers and retailers up in arms because of real skinny margins compared to their total revenue and gross receipts. We talked about you can't pass it on to customers. And we also talked about the record keeping problem. Farm and ranch accounting generally does not calculate COGS. So you got to do something else, which means extra time, extra effort, and guys like me and like Joe back here, we can't survive if our time's taken up and we don't get paid for it. So therefore, your accountants and attorneys are gonna charge you for helping with this. So the cost of the cat now becomes more than the tax itself. And we gotta wait for regulations to even know how to do it. So there's a few minutes left here. I want to just kind of close with a couple of other things here. One is that I think Jonathan is going to come up here and talk about what the Farm Bureau is doing and just kind of where this legislation is at. Before and I'm open to questions here too, but before I get to that, I want to take you back in history a little bit. I love studying history, but not probably the kind you get in the school system. The Roman Empire had a lot of taxes, and we're kind of getting like that. They had land taxes, trade taxes, military taxes, marriage taxes, inheritance taxes, sales taxes, religious taxes. You know, if you weren't part of the Roman heathen religious system, like if you were a Jew, for example, you got taxed because you didn't agree with them. There was a poll tax, there was a slave tax, state lands tax. I could go into detail, but you probably just soon it didn't. This is the way it was before, and it's the way it is today. So with that, does anybody have any questions? Go ahead.
So is this tax based on another state's example of how they're taxing, or did the liberals in the capital come up with it on their own?
Well, they have used some from other states. I think Ohio has a system that's been mentioned, and one other state, which I've forgotten right now, but they used them as a type of template, but then they tweaked it. So it's kind of a standalone, somewhat unique, but yet some similarities. Yeah.
So you mentioned it being a quarterly remittance or calculation of some sort. Does that mean that there's also an annual reconciliation that you parallel or feed into the regular Oregon state income tax routine?
Likely, what's written in the statute is the tax is to be paid quarterly, and I'm assuming it's like a lot of other quarterly things, maybe even the quarterly income tax, that it would be based on an estimated calculation and then a reconciliation at the end of the year. What I don't know is if this will then tie into the Oregon income tax return at the end of the year, or whether it'll be a standalone separate tax form, kind of like the payroll tax system. You know, we don't know that yet, that I'm aware of. Anybody else? Yeah?
Can you just clarify this, because I've now heard it both ways. On the 35%, so it can be read as the 35% of COGS or 35% of your income, or is it 35% of COGS and all of it?
You know that.
On both sides of labor.
Yeah, that is a good question, because I don't have a perfect answer. I was involved with this legislation near the beginning. I was asked to help some lobbyists work with it, and I got embedded in my head the idea that the 35% was a limitation, 35% of the gross receipts, that you were limited to that. But when I put my notes together here and reread the text of the law and some of the commentary from law firms, different ones coming out, they didn't say that. They just said 35% of COGS, period. So I think that's the way it is. But I can understand why there's some confusion out there, because I have changed my perception of that. So now I'm waiting until the regulations come out, see who's right. Hopefully that helps. It wasn't a good answer, but. Anyone else? I mean, isn't this fun? You probably want to look at the bulldozer picture again.
Mary,
Yeah.
I am a tax practitioner here in Oregon. Department of Revenue has regular meetings with us. The next one is a week from tomorrow. This has got to be coming up for us as tax practitioners so we can be helping our clients as well. So we need to be getting that on those agendas as well and educating the public.
Thank you. This is kind of an interesting, not exactly sidebar, but part of it. The Oregon Department of Revenue is going around the state on a listening tour, and one of those is coming up here in a week or two at Farm Bureau. I was invited to come to it. And the ones that one of them that was held recently, the feedback I got on it was not the best. People were in the room trying to get answers, and the party that sent me the email said that they were doing exactly what they said they would do. They were listening and they didn't want to answer any questions.
That was that one, the equipment was.
Yeah.
Like a lunch bottle.
Yeah.
So that goes along with some of the other stuff they come up with. And the people who are giving us the education don't know it themselves, or it's not correct, and we're supposed to interpret it.
A person could turn that into a huge, what would you call it?
Rebellion.
Well, yeah, rebellion. But they must think as practitioners and taxpayers that we are so brilliant that we can read their minds, we can do all this, but I don't think that's, no, it's, yeah, there's been, again, I don't want to turn this into a whining session, but all of you have your tax accountants and lawyers, and maybe you've observed this. It seems like the last, I'll say 20, 25 years, a lot of tax legislation is incomplete when it's passed. Regulations are slow coming out, and it's like there was a time it seemed like we had more certainty. We don't seem to have that. And, to use a farm term, I can stand before you here, or is this lady here too? And we have to act kind of like boneheads. We don't know anything. But it's not our fault, I can assure you that. So, well, enough of that maybe.
We just appreciate you bringing it to our attention. We know we need to be on our heels, looking for more information. I appreciate that. Thank you.
Thank you.